Mr. Reyna, when you suggest that $200 billion of commercial mortgage-backed securities in the marketplace, that will require refinancing, you say, over the next 2 years, what would happen to borrowers if CMBS lending is insufficient to cover that need of that sum?
Thank you, Mr. Royce. Basically, the borrowers become more in distress because if they have to go to a different type of lender, the CMBS lender is a very efficient lender that gives them best price and proceeds. It also provides them with a 10-year fixed loan that is non-recourse in nature. If they have to go to a different lender to refinance their asset when their loan comes due, they are probably going to go to a lender that is going to provide them, can only provide them shorter term, perhaps a floating rate loan, and will require recourse. All those things mean, to cut through the technicalities, the borrower is not going to be able to borrow as much for their asset. They're going to have to put up more equity, and if they can't do that, then they're going to be in default.
So what would the economic impact be, let's say, for pension funds or, say, life insurance? When you look at constituents out there, how would that affect them?
Sure. The performance of the bonds is what the pension funds and life insurance companies are interested in. If the underlying mortgages are not performing because when they come up to refinance, they have difficulty refinancing, then their investment is going to suffer as a result of that. And going forward, when they want to go and reinvest in those types of CMBS bonds that provide them the risk-adjusted return they're looking for, there's not going to be as much of that in the marketplace for insurance companies and pension funds to invest in, to provide them with the cash flow they need to match up with their needs with respect to beneficiaries.
So, as you know, European regulators are considering a high-quality securitization framework that could differ from U.S. rules. It appears that in Europe, they recognize that the current rules under consideration in their argument may be too onerous to support a liquid ABS market. If we don't have global convergence on these rules, what would that impact be on the U.S.? I'll ask Mr. Johns that question.
Well, if you don't have global convergence, you've got two issues. Number one, if Europe just goes its own way, then you'll see European collateral gets the capital relief. European investors get to take that capital relief. So consequently, they're incentivized to just invest in Europe, while the U.S. investor base will remain firmly based in U.S. assets. That creates maybe not a bifurcation, but it certainly fragments, a global market, and we all know markets are global. If you see Basel IOSCO take root, then all investors across the world, except for the U.S. right now, potentially could get this capital relief, meaning that they now can get a higher rate of return on capital by investing in the same product relative to what a U.S. investor might be. That means you're going to see more non-U.S. investors investing in the U.S. economy. I don't think that's a good thing. If you expand to what happens if we see another crisis and another bailout mechanism, what we saw last time was when local governments came in and gave money to their local banks, there was a stipulation attached to a lot of that they could only then relend it within that jurisdiction.
So the European Commission created a better regulations task force, and that includes a public call for evidence to review financial regulations and to consider ways to recalibrate rules to support market liquidity, lending, economic expansion. Doesn't it make sense then that we do the same?
It makes absolute sense. We've got a lot more to lose considering how liquid our markets are to begin with.
And I'll go back and let Mr. Reyna answer that and expound on that other question I had asked as well about the consequences.
Yes, I mean, there definitely needs to be an alignment between the U.S. and Europe and how they're applying these types of standards. And again, I think it goes to Congressman, just the idea of uncertainty in the marketplace with respect to how regulators generally are treating the capital markets. The capital markets are global. They're not just European or U.S., they're global. There needs to be harmonization between the two.
Thank you very much, Mr. Chairman. I appreciate the time.